In San Francisco and for Emily Chang, and this is Bloomberg Technology. Coming up in the next hour, record highs. Investors in love with the NASDAQ this Valentine's Day as tech index closes at another record. But with valuations stretched, is now the time to still be invested? We speak to UBS on their investment thesis. Plus, insidious aggression. U.S. House Speaker Nancy Pelosi comes out against Huawei, warning against ceding telecom infrastructure to China. We'll get reaction from Huawei on that and more. And Tesla turned our heads this week. We'll look back at some of the biggest stories in tech with Wedbush analyst Dan Ives. But first, to our top story, U.S. equities headed into the holiday weekend on a positive note after the release of steady figures for retail sales and with investors continuing to weigh contrasting data from China on the spread of the coronavirus. The S&P 500 closed at a record high after swinging between small gains and losses throughout Friday's session. To discuss today's market performance and how tech fared, we're joined by Laura Kane of UBS Global Wealth Management. Laura, to kick us off, I want to come and take a look at a chart here that I'm showing inside my terminal. I think, as you know, arguably the trade of 2019 was U.S. versus the rest of the world. I was speaking with David Kelly yesterday, the global CIO, JP Morgan Asset Management. He's trying to make the case for overweighting international equities. Are you still trying to overweight international equities, or do you think it's U.S. versus rest of the world?
Well, I would say right now we definitely see the U.S. in the lead, given that there's this kind of search for safety in light of the coronavirus. But that being said, you know, when we came into the year, the setup was definitely looking good for emerging markets, and we still remain overweight. The rationale being that we still think that once we get past the coronavirus fears, we're hoping the most of the impact will be contained to the first quarter, and then we should see a recovery in the back half of the year. And once we get that recovery, we still think the setup for emerging markets looks quite good, given the cheaper valuations, a widening growth differential relative to developed markets. And also some secular tailwinds that we see in terms of, you know, the e-commerce space and infrastructure and healthcare in those markets.
Laura, we've been talking a lot about the coronavirus. Since you mentioned it, has anything about some of the warnings we're getting from companies about supply chains over there changed the way you're investing?
Not at this point. So, you know, we're sticking with our allocations right now. We're sticking with our overweight to emerging markets. I will say that up until this point, we see that it's mostly a demand story and concerns about a pullback in demand. But if we do start to see more impact to international supply chains, and if this does drag on longer, I think that's where we see the downside risk to the market. So that's a situation that we're monitoring very closely. We have heard some manufacturing companies and some e-commerce companies mention some of these impacts to the supply chain. So I would say that is a key risk. But again, I think we only see kind of material risk to the downside in the event that the virus is not contained within the first quarter of the year.
Laura, I want to show another chart here that I'm showing inside my terminal, because so often we've talked a lot about the rotation between growth and value, and yet growth continues to be leading and sort of shrugging off any concerns that growth here would return back into a value trade. How much of the growth outperformance has been based on big tech?
Yeah, so growth continues to outperform, and a lot of it is driven by those big tech stocks. And right now, you know, we have a neutral allocation between growth and value because we do think that that growth stocks are starting to get expensive, especially if you look at, you know, tech valuations are at 11 years highs on a relative basis to the broader S&P 500. So, you know, we do see that those valuations are getting quite high, but at the same time, growth stocks do tend to do well later in the cycle, which is where we think we are. So taking those pieces together, we do have a neutral allocation between growth and value.
Ned Davis analysts have been traditionally a little bit bearish. Some of their concerns that they highlighted in their report today were the concentration of some of these big tech stocks that make up overall the S&P 500. Do you get worried about the concentration here of how much big tech is making up in some of these major indices?
Yeah, I mean, it is quite an interesting time when you look at, just the kind of top 5 names represent about 15% of the S&P and nearly 50% of the return. So that I think there is some risk there, but at the same time, there are some real secular tailwinds to some of those companies that we like. So, for example, we continue to be bullish on growth for e-commerce and digital advertising. So I think that there are, some enduring trends there that we like, despite some of the, more stretched valuations. So again, we have to kind of pick and choose among those top companies, but there are certainly opportunities that we still find attractive.
Laura, you mentioned stretch valuations. Come and take a look at this chart that I'm showing because it highlights those stretch valuations that you point out, mainly within the chip makers and the stocks. You're now trading at a forward PE basis of almost 20 times. You're near decade highs. Are you still a buyer here, particularly of tech stocks, the chip makers, with these stretch valuations?
We're not at this point in time. So we feel that the valuations got ahead of the recovery in semis. So that's not one of our preferred areas. Of course, there is some differentiation depending on which end market you're looking at. So we have seen some strength in chip makers that are focused more in the data center space. But overall, semis is not one of our preferred areas, mostly due to the valuations, as you mentioned.
And you said that you were underweight tech a lot in part due to the valuations here, but then you're overweight communications. Walk me through that.
Yes, so we're underweight tech mostly due to valuation, but we do, if you're looking for a kind of tech-like opportunity, we do continue to like internet stocks, and a lot of those companies tend to align with either communication services or the consumer discretionary sector. So for those looking for these kind of growth stories, these tech-like opportunities, the internet stocks is where we want to take our bets. And also, if you look at the valuations of a broad basket of internet stocks, they do actually look quite cheap when you compare them to other technology stories, whether it's software or semis.
Some of those internet stocks I think that you're referring to, and some that we've been talking here on this program a lot, were Facebook and Alphabet. Those were some of the top picks from the street heading into 2020. Really strong advertising revenue growth that they were looking at here for 2020. Yet, frankly, the market felt disappointed, particularly after earnings perhaps didn't live up to some of those expectations. Have you been surprised at the lack of these big companies to meet those high expectations?
I would say we wouldn't get too concerned over a couple of quarters of earnings. For us, it's really a longer-term story. If you look at the digital advertising space, you're looking about 50% of ad spending now is in the digital arena. So we do see this as a very long-term story. And with the growth that we're seeing in social media, search, even streaming now, we do see a lot of big opportunity in the digital advertising space. And we don't see this really slowing down. So we're not going to get too concerned about a couple of quarters of earnings and really are focusing more on the longer term horizon.
I read through your 7-page report on 5G infrastructure and owning the inevitable. How are you playing the bull thesis that is 5G?
Yes, so we see that 5G is it's coming, and where we see the best price opportunity is on the infrastructure side. So those communication equipment providers, we think there's an underappreciated opportunity baked into valuations versus the smartphone side, where we see is kind of maybe there's too much enthusiasm and valuations aren't justified. So we think that 5G is definitely coming. And the place you want to be is in the infrastructure space, specifically communications equipment and even some of the towers companies. The valuations there really don't seem to appreciate the big opportunity coming.
Laura, I want to end on a note when you talk about the themes for the next decade. So let's push it forward an additional 10 years. One of the things that you highlight is demographic change. How does that influence your investment thesis?
Sure. So one of the biggest demographic trends is aging and the shift in the balance of the working age population versus the older segment. And this is going to have profound effects across the world. I mean, it's something that we talk about in the U.S. with the aging of the baby boomers, but it really does affect have effects all across the globe. So when you think about the types of goods and services that are going to be needed, there's going to certainly be greater demand for healthcare, especially kind of tech-enhanced healthcare where you can reach more people at a lower cost. There's also going to be demand for critical services to, take advantage of that demographic dividend in emerging markets. So making sure that the youthful population has the education and resources to really contribute to growth in those countries where they can take advantage of having a greater balance of young people versus old. So we certainly see this dynamic of an aging population really changing the landscape over the next decade and beyond.
Well, themes for the next decade. We'll have to get you back to break down all of those. That was Laura Kane of UBS. Thank you for joining. Now, Softbank will invest $1 billion from its Latin America fund this year. The Japanese firm will focus on e-commerce, healthcare, and fintech. Softbank raised about $5 billion for the fund and launched it a year ago. So far, it has invested in 17 companies and 2 venture capital firms. And coming up, the U.S. hits Huawei with charges that sound right out of a mob movie. We will get the response directly from Huawei's chief security officer next. And if you like Bloomberg News, check us out on the radio. You can listen on the Bloomberg app, Bloomberg.com, and in the U.S. on SiriusXM. This is Bloomberg. U.S. House Speaker Nancy Pelosi is backing President Trump's assessment of the threat posed by American allies doing business with Huawei as countries like the U.K. begin to allow Huawei into its 5G networks.
Such an ill-conceived concession will only embolden Xi as he undermines democratic values, human rights, economic independence, and national security.
This comes after the Trump administration has been putting more pressure on the Chinese telecom. It's using a racketeering law normally associated with mob prosecutions to claim the company has stolen intellectual property for decades. The U.S. is trying to persuade allies not to let Huawei help build its 5G networks. And now let's head to Washington to hear directly from Huawei as we welcome in its Chief Security Officer, Andy Purdy. Andy, thank you for joining. First, I want to get your comments. What do you make of Ms. Pelosi now joining in Trump about their concerns over Huawei?
Well, the fact that Speaker Pelosi and President Trump can agree on anything is pretty miraculous, but it demonstrates that there is a all-of-government approach by the United States to use every tool in its arsenal, including bringing together 20 years of previously resolved civil issues, to try to hurt China and to hurt China by hurting Huawei. And the fact is, the United States is going to hurt Americans much more than they're going to hurt Huawei.
Andy, as we were reading through some of the charges about IP theft, a lot of it came that Huawei wasn't investing a lot in its own R&D, and that's why perhaps maybe it was stealing IP from other companies. Huawei's private, so we can't see the R&D numbers. But what can you tell us about R&D and the spending that they have done to help alleviate any concerns that they've been instead stealing IP from other companies?
Well, Huawei didn't become the world-recognized leader in 5G technology by stealing other people's intellectual property. I mean, we have over 11,000 patents in the United States alone. Last year, we spent $15 billion for research and development around the world. We're going to spend $20 billion this year. So one of the great things is, as a former federal prosecutor, former attorney, that the United States courts are going to require evidence. And not just braggadocio and repeated claims and trying to browbeat other countries into blocking Huawei.
You know, some of the other concerns were Huawei in the past has said that they blame some rogue actors from stealing. This was in part when they got caught stealing a photo of a robot from T-Mobile, and they say, oh, these are rogue actors. What can you do to alleviate concerns that this isn't orders from the Beijing government, that these were indeed rogue actors who have stolen some of the IP?
Well, there are a lot of issues subsumed within your question. The fact is, the issue you're talking about was a previously resolved civil case where the court found no malicious conduct by Huawei. But still, despite no additional evidence, the United States decided to bring that as a criminal case in the Western District of Washington. So in terms of the United States, we can put in place measures to prove that we are not subject to the undue influence of the China government, either regarding who we sell our products to in the United States or how we service those products. And we would just like the opportunity to have that conversation with the United States. So perhaps the United States would consider looking dispassionately at the potential benefits from Huawei, the consequences from not allowing Huawei to compete, and the potential risk mitigation that can provide assurance and transparency.
Let's have some of that conversation now. What can you tell us about any interactions that you have or have not had between Huawei and Beijing?
Well, we operate in 170 countries in the world, and we have the necessary communications with governments in those countries. And we strictly abide by the laws of the countries. But we are a privately owned company. Our records are open. Anybody can take a look at it. And we're not going to be forced by any country in the world, and we've never been asked by any country, to steal data or implant backdoors, and we never would.
Huawei has been very successful in Europe, namely the UK has said that they will allow Huawei some partial access to help build out some of those 5G networks there. What is your response to that UK decision?
Well, the UK is using evidence on which to make decisions to make sure the citizens of the UK are safe. I just saw a major Canadian telecom just came out dispite all the pressure, and they're going to use Huawei. Germany and the European Union are going to try to deal with things based on real facts. The China government's allowing the European companies, Ericsson and Nokia, to compete against Chinese companies because they see the benefits of competition. The United States, as the UK and Europe, could benefit by encouraging competition in this space.
Huawei's Andy Purdy, thank you as always for joining. Now, Oracle's Larry Ellison is fiercely competitive, always seeking an edge over competitors, including Amazon. So much so that Ellison is now making friends with his enemy's enemy. Joining us on the phone is Eric Newcomer, who covers tech and politics for Bloomberg News. Eric, it's so interesting. Trump doesn't get a ton of support in Silicon Valley. What does this say about Ellison and Trump teaming up?
You know, Larry Ellison is certainly somebody who's willing to do things his own way, and then he's also super competitive, and I think both of those play a part here. You know, on the one hand, Trump is someone who's been causing lots of trouble for Jeff Bezos, and Larry Ellison and Jeff Bezos are competing on sort of big government contracts, so there's a lot of tension there between Oracle and Amazon. And then on the other hand, you know, Larry Ellison is someone who's supported Republicans in the past, held a fundraiser for Marco Rubio, so has been someone who, in blue Silicon Valley, has supported, you know, Republicans.
Eric, what do we know? We know on Wednesday, Ellison is going to host a fundraiser for the president in his home. Top contributors are expected to shell out, or perhaps looking to shell out, about $250,000. What, though, is the goal of all of this? What are some of the issues do you think that Ellison is trying to tackle here?
I think, you know, if you're a billionaire, certainly happy that, you know, probably Trump's biggest policy agenda was lowering tax rates, you know, from the outset of his administration. And then, you know, there's been this fierce fight over the Pentagon's JEDI contract, and Trump, you know, has criticized Amazon's bid for it, you know, has reportedly sort of looked to screw Amazon in the process. So to the point, a judge is now holding up Microsoft's sort of wing of the contract until Amazon finishes its court case. So you know, there's everything from tax policy to these government contracts that the president could have sway over.
Are you surprised by Ellison's support?
I think it's surprising just given how few Silicon Valley leaders are willing to come out on this. Peter Thiel obviously spoke at the Republican convention the first time around, and that was such a contrarian bet. As we said it sort of over and over again, talking about Thiel's decision, and now we're starting to look at it this time. So Ellison's, holding the fundraiser, and there's sort of this question: if it looks like Trump could win, if Bernie Sanders becomes the Democratic nominee, where do these other wealthy tech leaders net out?
And besides the wealthy tech leaders, who do the employees support?
Yeah, the tech employees seem to be much more left-leaning. Looking at donations in the fourth quarter, Bernie Sanders got the most. Warren is popular. So, they're donating to Democrats, and among the Democrats, they seem to support sort of the left-wing Sanders-Warren types generally. So yeah, and we've seen reports now with this fundraiser planned that there are Oracle employees who are clearly upset that he's going to host the fundraiser.
Well, our thank you to Bloomberg's Eric Newcomer, all things politics and the intersection of technology. Now, T-Mobile has received a nod for its merger with Sprint, but what does that mean for Sprint's owner, Softbank, and other wireless carriers? We'll have more details next. And it's all about Wall Street Week. The show airs tonight at 6 p.m. on Bloomberg TV and radio, and it is available everywhere online. This week features IHS Vice Chairman Dan Yergin.
We're already looking at a very big decline. That in February, Chinese oil demand is more than 20% lower than it was a year ago, and world oil demand is certainly going to be much lower than had been anticipated. We think it's going to be lower than the growth than other people think.
An Illinois company that rapidly expanded over the past 2 years to deliver packages for Amazon is now shutting down operations in 5 states. The firm, called Bear Down Logistics, will also let go about 400 drivers after failing to meet the e-commerce giant's standards. The move underscores the challenges Amazon faces while outsourcing deliveries to new untested companies instead of traditional partners like UPS and FedEx. It's also a warning to delivery partners that Amazon is willing to cut them off. Now, there was news, of course, that T-Mobile is cleared to close its merger with Sprint earlier this week. We were talking about that, and I want to thank our guest, Craig Moffett, for continuing to stay with us. Craig, thank you. Just talk to me again. Are you surprised that this merger went through?
Well, I was a little surprised about the way the judge made the decision. I think I said before the break, sort of 50-50, and so was almost everybody else in not knowing what the final decision would be. But when you read the judge's decision, it's a sort of personal view of what he thinks should happen, and I think that speaks to why it was so hard to predict. It's just really hard to decide or figure out what one person is going to decide in a case like this.
And I was reading through your note, and you argue, frankly, that Sprint needed this more than T-Mobile. What does this mean for Sprint?
Yeah, no question about it. T-Mobile was going to be fine either way. It's good news for T-Mobile, but they were going to be fine either way. But for Sprint, this was really a make-or-break decision. They would have been in very dire straits without it. So clearly good news for Sprint, and therefore, by extension, great news for their corporate parent, Softbank, as well.
Before we get to Softbank, what does this mean for the new T-Mobile? What does the new T-Mobile now look like to you?
Well, T-Mobile is in a really interesting position. Remember, T-Mobile on its own has been growing very, very rapidly in a very slow-growth wireless market by taking share. And this gives them an even better story to tell. Sprint obviously brings a lot of cost synergies. That's nice to have for margins and that sort of thing. But it also brings a lot of spectrum and network assets that, when combined with T-Mobile, gives T-Mobile what will arguably be a real network advantage versus AT&T and Verizon, for the first time that either of those companies have ever faced a company that has had a better network than they do.
Craig, you mentioned Sprint's parent company, one of the parent companies, Softbank. Softbank really needed this as a win as well, right?
It sure did. They've had their share of tough breaks, shall we say, with WeWork and Uber and BrandWorks, and they've just taken one blow after another, and so it's obviously been a rocky time for SoftBank, and had they lost this as well, it would have been a big problem. This is still a big piece of their equity value. They would have potentially had to take it in and take Sprint's debt onto their balance sheet. All those problems are now washed away. So a huge win for Masasan and SoftBank.
Craig, I have to bring it back to the consumer. What happens to my phone bill? Are my prices going up?
Well, I suspect probably not. But look, there's a reason why antitrust analysis and HHI says 4 to 3 is usually not good for prices. This case may be different. T-Mobile has some commitments under the consent decree to keep prices down, and they will clearly try to take share. But I think what the judge decided, interestingly, although the judge did spend a lot of time sort of deciding that he could read the motives and intentions of the various players with great acumen, but what the judge decided was that price isn't really the only thing that matters in this market, that consumer welfare is also a function of the quality of the networks, and that this would give a boost to Sprint T-Mobile in the sense of having a much stronger network that would almost necessarily force Verizon and AT&T to invest aggressively in their networks, and that's good for consumer welfare.
Well, our big thanks over here to Craig Moffett of MoffettNathanson. Now, the U.S. Federal Trade Commission just ordered major technology companies to fork over details on waves of small acquisitions made during the last decade. A more sizable deal is also seen as a target for the regulator, Google's $1.1 billion purchase of mapping app Waze. To discuss this and all of the other top stories of the week, it is Wedbush Managing Director Dan Ives, and also with us, Techonomy founder and Bloomberg contributor David Kirkpatrick. I want to start with that FTC news. David, I was speaking to an analyst earlier this week, and he said of the big 5 companies that were targeted by the FTC, Facebook, by and large, is at most at risk. Do you agree?
Probably. I think Facebook's behavior just has generally been more reckless. So even though we don't know what they will find in such an investigation, my guess is there's more likelihood they'll find questionable things with Facebook. And it's partly because this is the youngest company of the 5. And in effect, it's the most immaturely run, in my opinion.
Dan, your thoughts. After Facebook, who else? Is it Alphabet? Who else is most at risk from this becoming a real threat?
Yeah, I think it's Alphabet. And I think also this was a shot across the bow in terms of at FANG and larger tech, just showing that acquisitions are going to be a lot more scrutinized. And I think when you look at Facebook and Alphabet, obviously front and center, Apple has obviously not been acquisitive. But I think this was, looking back, but also even looking forward as the strong continue to get stronger in big tech. And this is becoming, really a political football that's being tossed around across the Beltway.
David, I think some of the concerns are always around the big acquisitions. You think in Instagram, you think of WhatsApp. This FTC order, though, is targeting those smaller acquisitions. Sometimes the smarter acquisitions are harder to break out. Maybe they're bought because of the talent. How do you now go back and break out the small acquisitions?
Well, I'm not sure we'll see them requiring anything to be broken out, but even analyzing the impact and hypothetically what would have happened if these little deals had not occurred is going to be really, really difficult. So I think this is in many ways an unusual effort on the part of the FTC, and I frankly don't know exactly what they're heading toward. One thing, though, that it really does say is that all of these companies have entered what is effectively a new era of constant scrutiny and greater eventual regulation.
Dan, I have to ask, why are we talking about antitrust instead of data privacy?
Well, data privacy is going to continue to be there, but I think it's really, if you look what's happening right now, I mean, in terms of tech, you're seeing across all different segments, stronger getting stronger. I think from an antitrust perspective, that's really becoming front and center. Data privacy, we've seen obviously over the last few years, is going to continue to be a focus. But in terms of antitrust, I think as a general risk to FANG names, that's really right now very topical for tech investors going into 2020. And I do think this just shows M&A is going to be a lot more scrutinized going forward.
I want to switch to another big story that we were following this week, and that is the shared ride companies. You had Uber reporting their quarterly earnings last week, and then Lyft, of course, reporting out earlier this week. David, let me start with you. Are you surprised that Lyft wasn't able to match the earlier timeline of profitability that Uber came out with?
Not really. I think both companies are on shaky ground in some sense at the macro level. On the other hand, Lyft is in a better financial position than Uber by a considerable margin. It is much smaller, but if you look at the amount of cash it has enough cash at its current burn rate to last for something like 7 years. Uber, on the other hand, if it keeps losing money at the rate it's losing, it only has enough, despite the fact that it has like $11 billion in cash, that would only last it like a year and a half. So Uber has a lot more pressure on it. But, I don't think we've really proven that either of these businesses ultimately is a growth business long term from a profit standpoint.
Dan, AB5 hasn't actually hit the numbers yet. It doesn't seem like these companies are struggling yet. Is that a real headwind?
Look, AB5 right now, if you look, it's an $8 to $10 overhang on Uber and Lyft. I think both those stocks. And I can tell you, every day I'm talking to investors in AB5, trying to quantify the risk, where this can go, especially as it goes to the court systems. Is this going to have more of a ripple effect? You look at what's happened in New York and other cities, and maybe even, across, the different countries. I think right now, our view on AB5 is that it's going to be less draconian than feared once it goes through the courts. But no doubt, it continues to be a risk for the gig economy, especially Uber and Lyft front and center.
David, I want to switch to another story that we talk about every day here on Bloomberg Technology, and that is the story of Elon Musk and his Tesla. They, this week, sold about $2 billion in equity to help shore up the balance sheet. David, is the question, I guess, why not? Because you're at $800 a share with a $147 billion market cap?
I know. When I started covering business, there just was not drama like Elon Musk creates. It's very gratifying for a journalist like myself to have something like this to talk about. It's so amazing. But yeah, I mean, look, if a company's stock is up 90% or something like that since the beginning of the year, and it's a company that not long ago was being discussed as possibly on fundamentally shaky financial ground, if they can raise a couple $1 billion to give themselves some insurance, it makes perfect sense to me. Also, it seems to me that even though Elon Musk said it late January he didn't need more money, this coronavirus thing has become more and more of a question for the Chinese economy, which is a giant part of their business. So I think they may want insurance just for that reason alone.
And Dan, are you as an analyst happy with the equity raise because you now have an improved balance sheet?
Yeah, I mean, look, I think this was just a majorly smart strategic poker move for both Musk and the board to make this right now, because that's the key right now. If you look, it comes down to the capital. They need to shore up the balance sheet. This was the right move that they needed to do, and I think it really puts a floor in the stock, in our opinion.
Dan, as a follow-up, they have a factory in Fremont, Shanghai, Berlin. Where are they building next?
Look, I think that's the question. But right now, you really need to firm up Europe. That's going to be the key in terms of, Europe, building out Giga 3. And this is going to give them the trajectory where they could be at 750,000, 1 million delivery down the road in terms of what they could produce. And that's why right now they're in a position of strength, both from a demand and a production standpoint. It was the right time to raise the capital, but a lot of Capex going forward needed.
I want to talk about Capex. David, let me bring you back in here. There were a lot of concerns that the company had been under-investing last year to make sure they hit their profitability targets. Do you want to see, are you happy with that $3.5 billion Capex budget and that big ramp up in spending?
I think it's a good idea. I mean, the company seems to be, despite a lot of turmoil, a history of turmoil, a newly announced SEC investigation for reasons we don't really even know anything about. I think they're managing the company really well, and yeah, I think they're investing wisely.
Dan, can they still reach their profitability goals? They have $1 billion in free cash flow, but they now have a doubled Capex budget of $3.5 billion. Can they still be profitable at those levels?
Look, we believe they can. And I think ultimately, if you look at the stock, but forget just parabolic short squeeze, it's really when could they get to $25, $30 earnings power? And China's key there. And I think investors are obviously going to need to see the forest of the trees here. But if you look at profitability, especially Giga 3 being the linchpin and what's happened overall in demand, I do believe they could be profitable sustainably. You combine that with everything they've done from the capital perspective, showing up the balance sheet. It's a great 1-2 punch from Musk and Fremont.
Well, it wouldn't be my favorite topic of the week if we didn't mention Capex and balance sheets of Tesla, along with Dan Ives of Wedbush and Techonomy founder David Kirkpatrick. So thank you both for joining. And Bloomberg will have plenty more on Tesla and the electric vehicle market next Friday as part of a 1-hour special, EVs on the Brink of Change. It's airing next Friday at 9 p.m. in New York and 11 a.m. in London. And coming up, how an online marketplace aims to make sneaker resale more accessible. That's our conversation next. This is Bloomberg. Sneaker reselling is a burgeoning market, but it may not be accessible to everyone. That's the problem that online platform Goat tries to solve. Founded in 2015, the startup positions itself between the primary and resale markets. For more, Goat co-founder and CEO Eddie Liu joins us now here from Los Angeles. He's the latest guest in our Retail Transformed segment. Eddie, okay, I want a pair of shoes for about $1,300. Why would I come to you instead of, let's say, Nike, for example?
Hey Taylor, how's it going? Well, first of all, Goat's the global platform for style. So we really want, our whole mission is to make our buyers globally just feel and look the greatest. And so when we launched Goat in 2015, my co-founder, who's been a lifelong sneaker enthusiast, his first pair of Jordans were bought when he was 10 years old from his dad, and he was super nostalgic about them. So 23 years later, Nike retroed or re-released these shoes. So he went on the largest marketplace at the time, which is eBay, to go buy these shoes. He bought them, received them, took them out of the box, and he was so upset because they turned out to be fake. So Daisha and I were just like, how come in this day and age you're spending $300 on a pair of shoes and you still have to worry if it's real or fake? So we said, let's build a marketplace based on trust and safety. And how we did it was we pioneered what we call ship to verify, which means, Taylor, whenever you buy something on Goat, the seller doesn't ship to you directly. The seller actually ships it to one of our warehouses globally for us to authenticate. We use machine learning plus human technology to authenticate this product before and then we quality inspect it, and then we send it off to you, the end buyer. So that's why we just have a business. Nike's the most counterfeit brand in the world, and we're here to protect the buyer from that kind of thing.
You've mentioned shipping twice now. There's a two-pronged approach, and you're passing that cost on to the customer. What was your concerted effort or decision-making to pass that shipping cost on to the consumer and not eat it yourself?
It's actually because it's such a big value proposition, because there's so many counterfeits in the industry. I mean, last year alone, we prevented over $72 million of counterfeits on our system. So it's something that, yes, there is an additional cost to it, but I think for the consumer, would you rather spend $500 on a pair of shoes and have it be fake, or would you rather spend a couple extra dollars on shipping to make sure something is authentic? And that's what we've seen, where the customer really understands and values our value proposition.
There's a big trend going on in the retail market right now. It's called direct to consumer. How are you handling the increased wave of direct to consumer?
For us, because we are primarily in the secondary markets, I mean, our sneaker resale is primarily secondary, so we accept all forms of purchase. I mean, whether the consumer buys it direct from a brand like Adidas or Nike, or the consumer buys it through a retailer like Foot Locker, the case is the fact that for us, Nike and Adidas have, certain SKUs that they release direct, and these brands and retailers have a few hundred SKUs at any given time that they're selling. If you look on traditional websites, it's probably 1,000 or 2,000 SKUs. As opposed to on Goat, we represent the past, present, and future for sneakers. So we have over 75,000 SKUs that you can buy from, which means that, yes, you can buy the current season styles direct, but if you want something from 5 seasons ago, something like my co-founder, he was nostalgic about something 23 years ago, that's when you go to Goat.
Okay, well, Eddie Liu of GOAT, thank you for joining us. And it's still ahead. With Brexit signed off, the UK is now in the process of negotiating new trade deals. What this means for the future of its tech sector, that's next. This is Bloomberg. Now, I want to get back to Huawei and a story that we touched on earlier. The U.S. government is backing down in a dispute with the U.K. over using the Chinese tech in 5G networks. The U.S. won't be changing its policy on intelligence sharing with the U.K. after Britain's decision to allow Huawei into its 5G networks. To discuss this and plenty more regarding U.K. technology, I'd like to welcome Russ Shaw. He is the founder of Tech London Advocates. What do you make of Huawei UK partially partnering up?
Yeah, I think it's a good thing. I think it's a good thing because it's important that the UK engage with Huawei, and I think the UK has mechanisms in place to ensure that any software or hardware that gets deployed into the 5G network gets independently evaluated. There's something called the Cell, just north of Oxford, staffed by about 40 people, run by the government and the National Cybersecurity Center. So before anything goes into the UK network, it has to pass inspection. And I think that's a really interesting model that the UK has developed that I think other countries, like the US, should be taking a look at.
The UK is also going through its own post-Brexit trade negotiations with the EU and the US. What are they going to do about tech talent and that human capital in those trade deals?
Yeah. Taylor, it's a huge issue. And my community has been a very outspoken voice on the importance of getting visa and immigration policy correct. There's different tiers of visa and immigration policy. The Tier 1 visa, some good steps have been taken to introduce some new visas. It's the next level below, kind of the CTO, software developer level. There's a cap on that at the moment. And we've said, look, even before we formally leave the European Union, say at the end of the year, lift the cap. That sends a really positive message globally that the UK is open for business, even though it's leaving the European Union. But it is something that needs to get done correctly.
Back here in the U.S., we are in an election year. What are your thoughts on technology's increasing role in the election year, namely around political advertising?
It's a really significant issue, and I applaud companies like Twitter and to a certain degree Google who've said, look, we're going to prevent this from happening. The 2016 election was fraught with so many issues. So great that they're doing something. Disappointed that Facebook hasn't moved in the same direction. This is going to be a wild year ahead, and I think the big tech companies need to behave responsibly so that democracy can happen and unfold in an appropriate way.
Is big tech ready for 2020?
I don't think so. I think some of these organizations are preparing, and even companies like Facebook are saying, look, they are putting more in place. But I think if you talk to people on the street who use their products and services, there's growing anxiety that there's going to be a lot of problems with this election unless big tech behaves more responsibly.
One of the problems we saw was in the mobile app in Iowa.
Yes.
And then you had New Hampshire, and then Nevada has said that they will not use that same app. It highlighted how unprepared big tech is for the elections.
Yes.
Is that an example of how unprepared we are?
I think it's a really good example, and I think the debacle with the app in Iowa just illustrated that you have to do so much rigorous testing, which many tech companies do, but the parties were not prepared for it. I'm an American. I live in the UK. We still use paper ballots for everything, and I think there would be a significant outcry if too much technology got involved in something that people consider to be a fundamental democratic right. And so I think there's some lessons learned from Iowa that we have to adopt quickly, otherwise you undermine people's trust in democracy.
You had applauded Twitter and to some extent Google earlier. Facebook,
Yes.
of course, is on the flip side of that. Some of the questions, not only about political ads, but then how they treat influencers, who a politician could pay an influencer to post something about that politician. How does Facebook tackle all of these issues?
Well, I think they really need to take a deep, close look at themselves and their behavior, and talk to people on the street who are using their services, because, you know, many of us love what they do. You know, I use Facebook, but if they're getting too involved and going beyond what is appropriate, they have to think about how they rein themselves in. And we haven't seen the signals from Mark Zuckerberg and others at Facebook to say, look, we're going to step back from this and step back from that, because we know it will go too far into undermining democracy and the democratic institutions. And I think as they grow in size and scale, they have to be a responsible citizen and take a good close look at themselves.
Well, still waiting for that, but
Yeah.
Thank you for that analysis. That was Russ Shaw, founder of Global Tech Advocates. Thanks for joining. And that does it for this edition of Bloomberg Technology. Bloomberg Technology is live streaming on Twitter. Check us out at Technology. And be sure to follow our global breaking news network at Quick Take on Twitter. This is Bloomberg.